From Morningstar.com, I'm Jeremy Glazer. What's the best way to evaluate dividend stocks? I'm here today with Josh Peters. He's editor of Morningstar Dividend Investor to answer this question. Josh, thanks for talking with me today.
Thanks, Jeremy. Good to be here.
So for someone who is taking a look at a stock and primarily they want to get yield from it, what are the steps that they should take in order to evaluate it?
Well, my process is really based on the idea that getting the questions right, at knowing which questions to ask about a specific business when you're looking at it for the first time and then subsequent as you're evaluating it, that those questions are, if anything, more valuable than the answers. Anytime you make an investment, no matter how conservative, no matter how much you're trying to set aside speculation, you are making projections about the future because that's where your profits lie, your dividend payments, your capital gains, everything. In order to frame the question about the uncertain future, I think you have to have good questions. And that's why about 6 years ago, when Dividend Investor was still very new, I broke the whole process down into 3 questions that I call my dividend drill. And all the 3 questions are about the dividend. That's mostly what I'm interested in. That's what I expect not just to provide income, but also drive the stock performance. So I ask, is it safe? Is the dividend safe? Will it grow? And what's the return?
So let's start with safety. How do you evaluate if a dividend is going to be safe or not?
Well, there are a lot of different factors to look at. Certainly as many situations, at least, as there are different companies out there. But I could break it down into kind of 3 big areas that you definitely need to pay attention to. One is the balance sheet. Just you have to be comfortable that the company is more than capable of meeting all of its obligations to bondholders or banks, employees, suppliers, even the IRS, in order to know that there's going to be money left over to pay dividends. So evaluating the financial strength of the company is very important. One thing newly introduced over the last year or so that I think can be helpful is Morningstar's credit ratings. If you're looking at BBB minus or better for a Morningstar credit rating, that's expressing that we're fairly comfortable with the company's ability to pay bondholders. That also will generally give you a good start toward finding a safe dividend. A second factor to look at is just whether or not the business is growing or shrinking. You're kind of either being born or you're dying in the business world. A buggy whip manufacturer might have a fantastic balance sheet and a very low payout ratio. More on that in a second. But if the business is shrinking, it may not be able to sustain that dividend long enough to make it a profitable investment. So you really want to find businesses that in a secular sense, kind of strip out effects of economic cycles, are at least stable, and preferably have some potential to grow. And then the third point is just looking at the payout ratio. How burdensome is the current dividend on the company's finances? How much room is there for, say, earnings to drop in a recession, or if there's some short-term bad thing that comes along to hammer profits, will still leaving you with your dividend intact. And that you have to view in terms of the volatility of the business. Very common for utilities to have, say, 60-70% payout ratios, 60 or 70% of their annual earnings going out to shareholders as dividends. That's generally a pretty safe mark because even in a recession, their earnings don't drop that much. If you're looking at a steel mill, there may be no payout ratio that's low enough to really say that it's going to be safe, or an oil refinery, because at the bottom of their cycles, they lose money. And they may not be able to part with any cash to share with shareholders at all.
If we look at the next question, which is will they raise the dividend? How do you gauge that factor?
Well, that I can break down into 2 pieces, and the first is the question: can they raise the dividend? Can they grow the dividend? And that's really a function of is the business growing? How fast? What are their opportunities to reinvest and expand their business over time? It can take some different forms. I mean, take Altria Group, one of my favorite companies. Stock's not real attractively priced right now, but certainly what I think is a good long-term hold. Everybody knows that smoking is in decline, and here Altria now, after having spun off its other units, is really pretty close to a pure play on domestic tobacco, mostly cigarettes. As that shrinks, what does that mean for the future? Well, if they can raise prices fast enough to more than offset that, that's a business that can actually grow. So, you may have to be a little bit creative about the way that you look at that, but the bottom line is, that profits have some potential to grow. Another piece, is of that can it grow is capital allocation. Does the company have opportunities to reinvest in its business? For a utility, it might be, building new power plants that are more efficient to replace old ones. They have more money at work, so regulators allow them to collect more from customers. One of my favorite companies, kind of the polar opposite of a utility, Abbott Laboratories, This is a company that is benefiting from very long-standing, very durable trends in healthcare. Yeah, there's a lot of pressure on healthcare costs coming from governments and insurance companies, but people are living longer. In emerging economies, people have more money to spend, and that's a quality of life issue that they can improve their quality of life. And as long as Abbott continues to churn out products like a Humira or a Xion stent, that materially improve the quality of people's lives, lengthen them, provide better quality of life, then demand for that business should be rising. And they have a lot of different lines of business to invest in. It could be Similac baby formula, add a new line there, or it could be some new drug development I couldn't even begin to appraise, because I don't have a PhD in medicine. Put that all together, I think you have a good growth profile. Where it becomes the will it grow question is, does management actually reward shareholders, directly, for the growth of earnings? Not all companies do. In Abbott Laboratories' case, you have almost 4 decades now of dividend increases on an annual basis. That tells me a lot about the way management is looking to reward shareholders.
And then on the final question, how do you think about the total return potential from a dividend stock?
Well, to me, it really breaks down into 2 components. Again, kind of doing this decision tree type of logic. The ultimate answer, from the is it safe question is really, the dividend yield. Let's say Abbott Labs, continue with that example. It's, roughly 4%. If you think it's safe, that's kind of the, part A. Part B is the growth component, which, I think, Abbott can raise its dividend about 9% a year, which is, a very good rate of growth, even if you didn't have that big yield. You add those 2 factors together, 13%. I think that's a very good overall total return. And to the extent that in the long run the share price should follow the dividend, up or down, then that 9% growth in the dividend on a yearly basis should correlate to roughly 9% a year capital appreciation. If you start off with a stock that's undervalued, which we think Abbott is by quite a bit, you may even do a little bit better than that. Now, how much return is enough? I generally use 9-10% as kind of a bottom end scenario. The more safe a company is, the more reliable its business is, and the larger its current dividend is, which takes a little emphasis off of that growth component to drive total return. I may be comfortable settling for a little less. If I'm looking at something where the yield is pretty low, but there's a lot of growth potential, maybe it takes 13-14% to really get me interested. And then at the final end of the spectrum, you find a company like one of my favorite little utilities, Piedmont Natural Gas. Stocks yielding under 4, dividend grows about 4% a year. Great business, but I think the stock is too highly priced, doesn't provide enough current income, for me to really take an interest there.
Josh, thanks for giving us these tools.
Hope it provides some good questions to ponder when people are out there looking at stocks. It's not easy, but we try to make it easy.
Thanks again, Josh.
Thanks.
For Morningstar, I'm Jeremy Glazer.
Develop a portfolio with cash returns and income growth with Josh Peters' Dividend Investor newsletter. Each month, Josh provides commentary and recommendations on top-notch dividend-paying stocks that should be on your radar. His 2 real money dividend portfolios deliver a fresh approach for those needing current income and those seeking income growth.